Reading the UMBS and Treasury charts can be difficult, but it is very important to understand what they mean so you know what is happening with the markets and really what rates are doing. It allows us to understand the stock market better, handle personal trades better, and know entry and exit points as well as the psychology of the market. The idea of Japanese candlesticks was founded by Steve Nissen. What is technical analysis? It is human emotion that drives the market, but quantifies it and allows you to see what is in the air. Japanese candlesticks, or Eastern signals, they do not tell you what the market does every day, but it will tell you when you are at an important inflection point, reversal signal for instance. If you are in an uptrend, then you will want to see a downtrend or vice versa. The first step in understanding the technical signals is to understand what makes up the candlestick. There are just 4 variables here, very simple. First, there is the color, which there are only 2 choices, green and red. Next, there are 2 different components to the candle. One is the thicker part, and that is known as the body, and the thinner part, which is known as the wick. That's it. So now let's talk about what each of these mean. Let's talk about the body first. The body represents the range of the opening price, first trade of the day, and the closing price or the last trade of the day. So essentially the thick body is going to give you the range between the open and the close. Next, the wick will show you the intraday high if above the body or the intraday low if below the body. So this wick will give you that range of or the distance of the entire day's trading top to bottom. We'll show you the high trade of the day and the low trade of the day. Next, why would the body be green or why would it be red? Well, that depends on the open and the close. If the opening price is below the closing price, in other words, let's say it opened at 1 and closes at 2, then the body will be between 1 and 2, and because it closed higher at the end of the day, then the candle will be green. If you have a red candle, that might have opened at 3 and closed at 2, so it closed lower than when it opened. Now, here is how the wick works with the candle. Let's use the same red candle. Let's say it opened at 3, but the intraday went up to 4. Then you would have that thin wick above the candle that is up to 4. Then if it closed at 2, you would have the body end at 2. But let's say that the intraday low was 1, then you would have a wick below the candle down to 1. Keep in mind that just because you have a red candle, that does not mean that the pricing is worse from the previous day. For instance, if the previous day closed at 20, however, say the next day it opens at 22 but closes at 21, well, it is a red candle because it closed lower than it opened that day, but it is still higher than the previous day. So red candle does not always mean pricing went down. However, this does tell you that something about the emotion of the market. There was something that made it open higher, but in the end, news or etc. made it go back down. Okay, next thing to understand before we dive into the deeper is that there are 2 types of markets that are in a tug of war. There is a fight between the bears and the bulls. There is a bear market or a bull market. Bulls, they want the market to go up. Think of it this way as the bulls attacks with their horns up in an upward motion, whereas bears want a downward market. They attack with their claws in a downward motion. When you understand all of this, we can start to determine whether a bull market is going to turn into a bear market or vice versa. All right, we got some background information out there. Now, there are Western and Eastern technical signals. Let's talk about the Western technical signals first, and the next video we'll talk about Eastern. As an initial comment, there are going to be multiple indicators discussed that we will look at. One individual signal by itself is not necessarily going to tell us what the market is going to do. However, the confluence of signals can give us a really good idea. As such, let's break down the different components. First, there are support and resistance levels to the markets. Imagine there is an office with multiple floors. Let's assume there is no gravity and you bounce a ball from the floor. Once it hits the floor, you would expect it to go up. And when it hits the ceiling, you would expect it to go back down. Support and resistance acts kind of like that. If you identify a support level for a specific security that you are trading, should hit the level and get a little bit of a bounce. If it hits the ceiling or the resistance level, then it should have a tough time breaking through that and coming back down. Now, this is just the basics of it. The certain security like the UMBS or the mortgage-backed security is not always going to stay constrained in the support and resistance levels. For instance, if there is enough force to break through the ceiling, then now you're in a higher floor in your office building, and what used to be your ceiling is now going to be your floor and you have a new ceiling. This is called the rule of polarity. We have a little bit of a self-fulfilling prophecy here. For instance, the people that are trading and decision makers are watching the markets and they have their computer program set to sell if it hits the ceiling or resistance level, and they have the computer set to buy if it hits the floor or the support levels. As such, you know when people are going to be buying or selling. If you're on a ceiling and everyone is selling, then the price is going to go down. This gives us some good insight on whether we should potentially enter or exit the market. Now, all this range between the resistance and the floor is called the trading range. Each of these candles represents a day of trading. We already talked about the candle. Now you can see in the chart, and typically when the candles reach a high level, it comes back down, and then it reaches a low level, it comes back up, like our floors we were just discussing. Okay, let's talk about the next topic, gaps at the open or the close. So you have a previous day's closing price. Let's say when looking at the chart, you have a green candle, which means the difference in the opening and the close is the thick body. So in the previous day, we closed higher. We also know that the lowest price of the day was the open because there was no wick beneath the green candle. We also know that the intraday, the price went as high as the top of the wick above the green candle. Then it lost ground and closed where the body ends and says it closes on the chart. Okay, let's analyze the next candle. We have a red candle, which means it's going to close lower than the opening price. So the open for the red candle day is above the close of the prior day. Let's assume the prior day closed at 20 and the next day opened at 21. Well, then there is a gap between, even though what we see is it closed lower than the prior day. Why does this happen? Well, maybe there was a buying interest so strong when they closed the markets for that security that they opened it at a higher price since there was more buyers than sellers. Finally, what did we see with the day end with? Well, we had that nice gap open to a higher price. However, the bears won this battle and drove the price all the way back down to the bottom of the red wick intraday and closed lower than open and even lower than the prior day. All right, so the next topic that will help us understand the markets and how they move is to understand moving averages. Moving averages are so important because they are natural ceilings and floors. Essentially, a moving average takes a period of time and the closing prices and averages them out. For instance, a 100-day moving average will take the 100 previous days closing and specifically what was the end of the day price for that security over the 100 days and averages it and plots it on a chart. We also look at the 25, 50, and 200. You can logically come to the conclusion that the shorter the duration, say 25 days, then the more movement you will see, but there needs a lot of movement for the 200-day moving average to show a big fluctuation. Let's take a look at the moving average chart. On this chart, you will see several lines. The first one is the green and the red candlestick line that we already discussed how to read and view. Next, we have different colors. For instance, we have the blue 200-day line, then you will see moving much more slowly compared to that of the purple 100-day, which has a little more movement. And then you'll see the black 50-day line, which will have even more movement. And then the red 25-day line, when you look at, will have the most movement. These moving averages help us to determine good entry points into the market. Let's look at the 25-day moving average. This is a good one to look at because it has more movement due to the shorter duration. If you look at the chart, you can see that the 25-day moving average can give you so much clues. You can see it acts beautifully as a floor of the support. Follow it along the chart and you can see it moving the candlestick line. Now, the 25-day moving average also has an important concept called the leash effect. Picture walking a dog. If your dog starts going a direction, you do not want the dog to go. What do? You tug the leash and pull him back. That is what happens with the 25-day moving average. So if it strays too far, then let's take a look at what happens. You can see that when prices started to stray a bit far from the 25-day moving average, you can notice that it strays too far from either the upside or the downside, then it gets tugged back. So when prices start getting too far for either optimistically or pessimistically, then we should start to expect to see some tugging from the 25-day moving average. This helps us to predict what rates might do. We have no crystal ball, but these indicators help us to most educated decisions that we can make when the market is telling us. Now that you have seen how to analyze moving averages, you can do that with the 50-day, 100-day, and 200-day. We'll see them move along the ceilings and floors. The next thing I want to discuss are two different types of crosses, the golden cross and the death cross. First is the golden cross. The golden cross is when you have two moving averages, the 50-day and the 200-day specifically. It is when the 50-day is underneath the 200-day and then it crosses above it. Market technicians look at this as the bullish indicator that now the momentum is to the upside. Then we see prices increase and we see upside pricing. In this chart, you will see that the 50-day acted as a floor support and that the golden cross indicated a beautifully upswing in the market. Next, the death cross. This is the opposite scenario as the golden cross, where the 50-day starts above the 200-day and moves beneath it. This will signify a downtrend in the market, as you can see in the chart. Essentially, this means that the bulls are losing control of the market and the bears are taking over. In this chart, this huge downtrend represented almost a whole 1% decrease in rates just from mid-December when you got the signal until mid-February at the bottom. How nice would it have been to warn your pre-approved clients back in mid-December that rates are going towards a downtrend? And let's get you in a home and lock now. See how these charts can help you peak in the future. The next indicator that we are going to discuss is the Fibonacci replacement levels. Fibonacci was an amazing mathematician and discovered that there is a relationship between things. The retractment is done by taking two extreme points within a range, a high point to a low point. For instance, a stock's high point was January 50 and a low point March 40. 50 becomes 100% high point and 40 becomes 0%, which is the low point. So what we are doing is trying to find out how that level will retrace. The percentage will show you the resistance level. So if the first level is 23.6, then your first resistant level is a scenario of 42.36. You will be surprised to know that the price struggles to move when it reaches this level. The Fibonacci is based on the golden ratio, which is 1.618 to 1. Let's look at an example. You can see in the chart that the security keeps moving up and down between the Fibonacci ceiling and floor until it finally breaks through it. The next indicator is called the stochastic indicator, and this is the momentum indicator. It shows a range between over 14 to 21 days of a top and bottom pricing and assigns a percentage to that, with the top being 100% and the bottom being 0%. It'll help us understand when a security gets ahead of itself. Essentially, these indicators are used to determine if a security has moved into an overbought or an oversold position. We use this in conjunction with other indicators. When we see we are in an overbought position, for example, then I'm going to look at the chart to see if there are going to be other indicators that will give me an idea of what will happen next in the market. We will look at a 3-day moving average to get a pulse of the market. We want to see what section is relative to the overall market. You can see that in each of the charts, being able to identify the stochastic indicator can help you decide when it is best to lock rates. We see 3 different indicators marked on this chart. In August, for example, we had an indicator that the market might be in for an uptrend, and sure enough, we gained 83 basis points in 19 trading days, which would be a great time to have locked clients. And look at the 113 basis points lost right after. How would you have liked to avoid that? All right, just 2 more Western indicators that we're going to look at. You will have to tune into part 2 to learn about the Eastern indicators. First, the window. A window is also a gap, but a more pronounced gap. It is a gap where you get a difference between previous day close and next day close open that is so wide that you have some white space between. In a falling window, it will open up well beneath the lowest low of the prior day and opposite with the rising window. This window can act like a ceiling and it can help for the future. As we can see in this chart, the ceiling held from September to November. The rising window will act as a floor, so same idea. Finally, a double top. It is a bearish and technical reversal pattern that forms after a security reaches a high price point 2 consecutive times with moderate declines between the highs or the ceilings of resistance. These charts are allowing us to see the emotion in the market as it reaches the top. Again, people will act accordingly and we will again see a self-fulfilling policy. I hope by going through these market charts analysis, you can also start to understand how the market moves and how rates are moving in an environment where we have very volatile rates. It is important to stay informed. Thank you, and I hope you found this interesting.